Thank you for joining us this Friday, the 27th of February. I'm Sophia Mavridis, and I'm joined today by Bell Financial Group's Chief Investment Officer, Will Riggall. Will, thanks for joining us again this Friday for another reporting season wrap-up video.
Oh, it's great to see you again, Sophia. And look, to be honest, it's been a pretty happy season. I feel like I'm a bit of a broken record every time I come and have a chat. Or I can say that we're up another percent, but we are. The ASX has had another strong week, up a bit over 1%, and put that together since the start of the month, we're up around about or just under 4%, which is really strong. We haven't had a month like this on the ASX for a while. But you put that into context, there have been real challenges for offshore markets, namely the S&P 500 and more so the NASDAQ, as that those tech ructions continue to roll through. But as we talk about, we've got a different mix of companies in Australia, albeit we will talk about tech, IT and technology today in the company. But yeah, I think we should all, the takeaway is that the Australian economy is strong, companies are performing well, and we've got some great global leaders here that we should be continuing to invest in.
Well, last week we talked about how those stock-specific drivers were moving sectors. What are you seeing in the sectors this week?
Yeah, it's a real mix again. Underneath this kind of 4% or this solid continual growth, we're getting real moves from sector-wise. But the winners this week were the materials sector, so resources again performing well. We do talk about stock specific, and if we talk about the staples sector, really we're talking about Woolies and Coles, and we have both of those companies report this week. The staples sector is up and around 4.5% so far, and then IT. So I guess last week we were bemoaning the challenges ahead for that one, but we've had a bit of a bounce this week, and IT has rebounded. It's up, the sector's up about 3% so far.
Well, you mentioned Coles just then, Will, so maybe we'll jump into that. This morning, Coles reported solid earnings and sales growth, and it lifted its dividend. However, the results did still seem to be relatively weak when compared to Woolworths. So Coles's sales revenue rose almost 4% from a year earlier, while Woolworths sales grew just under 6% for the same period. What are you looking at there?
Yeah, it's well, Coles has certainly had Woolies in regard to operational performance and share price movement for the last almost 2 years now. Woolies has significantly underperformed from a share price perspective, but also from an operational perspective. You talked about revenue growth, like-for-like sales. It's taken them longer than we thought to kind of get their mojo back, but this result really knocked it out of the park. The stock's up around about 15% this week. Coles, on the other hand, is down around 5%. What drove that big change is a final turnaround from the new management, getting the simple things, and they say retail's detail, and getting those simple things in place. And that's making sure your pricing's right. And if someone comes into the store and wants to buy to that price point, make sure it's on the shelf. So that was in-store execution was really strong, and it led to about a 6% EBIT beat than the market, and that's what drove that big hit. If we're comparing the two, though, we've seen a continuation of Woolworths' outperformance. In the first 7 weeks, they usually gave us an update around how the sales are going in store. Woolworths is sitting just under 6%, while Coles is lapping some tougher numbers as they benefited from the Woolworths challenges last year, but far below. And that's all about that sales line for domestic retail or our supermarkets. If you get the top line moving, all those gross margins and those margins really start to perform, and that's what you're seeing in Woolworths. Coles cycling tougher comps, possibly heading the other way.
Does Bell Potter have a preference of the two?
Yeah, it's actually been a really strong call from our analyst, Jonathan Snape. He picked moved from Coles to Woolworths late last year, and those that have followed Jonathan, and I suggest you should. He's very strong in this space, retail and agricultural, and he's called it well and continues and Woolworths continues to be our preference ongoing.
A strong stock for shareholders, I'm sure. Will, you also mentioned IT earlier, so let's move over there. WiseTech. So they announced this week they're cutting 30% of staff as AI reshapes the workforce. Yesterday, Bell Potter's commentary on WiseTech landed the Financial Review's front page. Rob Crookston, he spoke about how the stock is trading at a materially lower multiple. So investors that perhaps are looking now beyond short-term volatility, that the valuation is becoming more compelling relative to its outlook. Is that what you're seeing? Do Bell Potter see the WiseTech sell-off this week perhaps too aggressive? What are your thoughts there?
Yeah, WiseTech's kind of been the bellwether for Australian technology, and the challenges are at the moment you're seeing, will AI start to compete away these software as a service type businesses, ones that connect other pieces of data and information and provide tools in a way. So WiseTech's one of those. It develops tools that cargo shippers can use in managing their timelines and moving their stock around. It peaked at over $120 and today sits around 49. But if those who were quick enough to move on the timing, it's actually up 20% from its lows from intra-month. So sitting at about $49 today, our analyst Chris Savage still thinks it's great value, and I believe that if you're looking for and believe in the turnaround, I think certainly there's a lot of value on offer here. It's just the timing that's a little bit uncertain, as a lot of these concerns are future years. How will it be impacted? But you're right, Sophia. You talked about WiseTech's kind of brought the narrative back, taken back the onus on this around AI disruption. What they've actually done is almost disrupted themselves in taking that huge cost out, taking a big number of headcount out of the business, and saying that it's going to be reinvest in AI, and they're going to be agentic AI led, and that's how they're going to lead the next technology shift within their business. So, could foe be friend for WiseTech? And look, if that's the case, then it's trading a significant discount to where it will be trading in a couple of years' time.
Sounds like it's definitely a leader in the sector.
Absolutely.
Well, maybe we'll jump over to Fortescue Metals if that's all right with you.
Absolutely.
So FMG rewarded shareholders this week with a strong increase in a fully franked interim dividend. I believe it was up 50 cents from a year ago to 62 cents, therefore demonstrating a strong balance sheet, cash flow resilience. What are you looking at with FMG? What's your outlook on the stock? And perhaps even, I know we talked last week about BHP, so how do you compare them?
Yeah, look, I think Fortescue did a great job in announcing their results. They themselves came out and beat estimates in the market. EBITDA was about 5% ahead. And there's echoes here of why BHP has been so rewarded. The operating cash flow within Fortescue was up 32%, and that really gave them the confidence to pay that higher dividend. So again, strong end markets, they're performing well, the production's increasing, but also it's the operational performance that really is really strong. But what BHP had that Fortescue doesn't is that just that shift towards those future minerals, the copper angle at scale. And BHP had a great move last week, but we've seen them perform again this week. So Fortescue's up around 5% week to date, but BHP's continued. It's up over 8%. So look, we really need to be cognizant of what the market's looking for. Operational strength, increasing dividend, tick, but we're also looking for strategic shifts around the exposures of a company, and just BHP's exposure to copper and ticking over that 50% in an earnings share has really just sparked the Australian shareholders' interest.
Well, reporting season's drawn to a close now, Will. It's been a really strong month. What happens in the weeks that follow?
Yeah, we are. We're at the 27th of February. We've got the weekend coming up, and February's done. But it's actually when you have to get down to work. You have this flood of information coming at you, and you're dialing into calls and you're meeting management, but you just don't have the time to sit there and sift through the results and really think about the impacts of some of the items you heard. What that will lead to is everyone out in the market, both in retail and in institutional funds management land, will actually be going back to the key companies, the results they liked, the results they didn't like, and going through them with a fine-tooth comb and meeting those companies. And so there's usually another wave of shifts in portfolios that'll flow through again. So look, if you think you've missed a stock that you really liked, it's usually not the case. There's usually another, though those positive indicators and those positive fundamentals do continue on in the next month. So yeah, it's time to have a look through what we've heard and actually sharpen your pencil and go out there and continue to look at what you can do within your portfolios.
That's a really great insight, Will. And thanks for joining us again this Friday. And we'll catch you very soon.
Thanks so much, Sophia. Have a great weekend.
Same to you. Thanks.